Let's go. How's it? Hi. How's it? How's it? Hi everyone. Welcome to the stream. Welcome to the stream. My name is Towelani Mlunge. Towelani Zingume. You can call me Mlunge. Straight to the point. You can call me Mlunge. That is easy. I like that. Mlunge Gandlu. It's actually my clan name. So Mlunge Gandlu is my clan name. I'm gonna go try and go live on YouTube. I mean on TikTok as well. Let's see. Let's see if they can come and join us here on YouTube. I want on TikTok. They think they bougie and everything. They don't want to. They don't want to go out. But make YouTube. I mean, but make TikTok by YouTube. You know. Let's take this off. Okay. And we are on live and kicking. All right. So this is the channel. This is the channel Investing Pod on YouTube. You can check me out on TikTok. You can also check me out. It's Suit and Asset on TikTok. That is me. Right. I will blow up my TikTok as well. For those in the back, who need a suit, if you need a suit, what is this, man? Okay, yeah, this is me on TikTok. I'm live right now, as you can see. So I got all types of suits. I got suits for ladies, I got suits for men, 2-piece, 3-piece suits. Simple 1.9. And that price includes a delivery as well. I mean, I'll just pop this up. This is for chicks, right? This is for females. A 2-piece, 1.6. So you can see I got my number there. I don't know why they're hiding my number. Because if I need one number, you know, I don't mind. Yeah, that's my number, 0791453674, right? Yeah, anyways. Back to Investing Pod. Welcome. Thank you to everyone who's been watching the views. I mean, who's been watching the videos that I put up so far. Ngiyabonga support, and I promise I'm gonna keep them coming, and we're gonna do more. Hi everyone who joining TikTok. I hope you guys would join me on YouTube. It will be fun. It's more fun on YouTube because I'm actually sharing my screen, right? So as you can see here, all the description, right, about what this channel is about. But you can see like TikTok, I sell suit, right? TikTok I sell suit, and then on YouTube I talk about investing, I talk about business, I talk about finance, I talk about politics. So I want to right now, I have like 4 topics engifuna ukucover namhlanje. And it's assets versus liabilities versus equity. What's the difference between the 3 of those things, right? Number 2, we want to cover American stuff. Donald Trump seems like he was coming for Jerome Powell as well. Jerome Powell, for those who don't know, is the governor, or is the what is it? Is the reserve banker of the American bank, of which is the Fed, right? He's the chair. He's the Fed chair. Oh my goodness, I'm tongue twisting right now. Okay, let me forget the chat. You know, I'm looking at the chat and I'm looking at people on TikTok. That's why I'm getting my words mixed. So I'm saying Jerome Powell. This is Jerome Powell. Jerome Powell is the Fed chair. So he's usually the one okulumayo when either ama interest rates they're gonna go high or go up, specifically in America, right? So pretty much if he's in charge of America, America is like in charge of everyone else, right? So whatever he decides sort of trickles down to everyone else in the world, whether they are in Europe or they are in South Africa or they're in Africa. Hi guys on TikTok, there's no drama here. We learn. So if you're gonna come here to learn, please, you're welcome to stay. I enjoy everyone who wants to learn, but there's no drama here. Because there's this trend I've been seeing on TikTok. Females are going crazy. I don't know if it's toxic or izophelelapi, but they were going crazy. I saw this other one. It was a Zulu chick, umuntu wesifazane, it was a Zulu chick, and she was sort of competing with another chick from Zimbabwe, right? I don't know, like I'm still new. We're trying to go live even on TikTok, but the way they were going so hard on each other, right? So that I guess you kind of like have to vote, or you kind of like have to put in your pitch for like 30 seconds or 1 minute or whatever, right? And then after that, everybody waits, and then sort of the chat or the viewers, they start gifting, and whoever's gifted the most, I guess, is the winner, right? But it's the vile things they were saying to each other, right? I was like, females are going hard at each other, and it's unnecessary, man. It's unnecessary. Like we need love, man. We need positivity. We need each other. Whether the other one uhlala ngale or uhlala ngala. Even if we know that, but can we just coexist without us trying to always confront our issues like we all got something to lose? Man, the world is plenty. There's so much in the world, and there's enough in the world for everyone. But anyway, let me not soapbox or soap opera from the beginning. So what I'm saying is, today we're gonna talk about that. It's just that I saw that and I kind of like sort of triggered. It's like, there's no need for this. But anyways, so we're gonna talk about assets, liabilities and equity. We're gonna talk about Jerome Powell and Trump. We're gonna talk about how many stocks should you own in your portfolio, and then we're also gonna talk about waiting for the market to correct, right? Timing the market, right? Some people call it timing the market. You wanna get in at the right time. You wanna wait for the company to devalue. Maybe just cut 30% more. Mawukuthi ibiza 70 rand. Maybe it'll be cheaper. It'll be better if you can buy it for $55. That sort of thing. So we're gonna watch a few videos on that. Then I guess I'm gonna sort of give in my 2 cents, right? That's pretty much the structure of what we're gonna do today. But yeah, thanks to everyone who's been subscribing and everyone who's been watching the videos. I really appreciate everyone who's been commenting. I really appreciate. I will try to comment and reply to everyone. In fact, I'm gonna make it my utmost mission because I'm really trying to build a platform where we can share ideas. Not even ideas, information, ideas and information, right? It's the same thing, I guess. Yeah, but and it's not. It doesn't have to be a one-way street, right? It doesn't have to be just me ranting and stuff. I always say, like, I'm putting my number there. That number, also use it for WhatsApp, right? I'll be keen if you text me and then maybe you have a topic or you want something to discuss on stream. We can get on a call and then we talk about it, to discuss it, because I think that's pretty much the state we are in South Africa. I think we're in a state of, we need dialogue, and we need to have more dialogue, and then hopefully, it leads to something someday. But we need to start building these communities, whether the core purpose is investing or the core purpose is selling each other suits, but the whole purpose is sharing information. For me, that's what it's about, right? Anyways, let us start. I guess that is my intro, 9-minute intro. Where do we start? We're gonna start with assets versus liabilities. Okay, where are we starting? Assets and liabilities, right? So there are three things, right? In investing, you pretty much have to be cognizant all the time when you're investing. And those is like the distinction between assets, liabilities, and equities, right? Because pretty much if you find my financial statements, that's pretty much what you're going to hear. Those are what we call about equities, those are what we call about assets in relation to equities. Sometimes people saying the stock is overpriced, or maybe they don't have assets to back the price. You understand? Or their assets are not generating enough cash. They're not using their assets to generate enough cash, right? All that jargon and all that talk, what does it mean? So let's break it down. I think the simplest thing, or the simplest way to try and start to break it down, we'll be putting it in a house format, right? So mounting in, right? If you buy a house, you usually buy a house using your own money, right? But you don't use your whole money for the full amount. So let's say in Libiza 5 million, right? And you have in your savings what 1 million. You have 1 million in your savings. Where are you gonna get the other 4 million, right? You're gonna finance it through a bank, or a bank. So the simplistic idea of it is that this million of it, this lily million lako, right? Okay, think of it as qale phansi. 5 million is the asset, right? It's the total value of an asset, right? But then within an asset is divided into two parts, or it's financed in two ways, right? So it's financed with your own money, and it's also financed using the bank's money, right? Or using someone else's money. Usually it's a loan, of which it's equity. I mean, it's debt in this instance, of what we call liabilities, because liabilities are usually debt, not even usually. Usually it's debt. It is payables as well. Like liabilities also include things like payables. Let's say maybe you are a spaza shop and you order stock and you ordered it in a squelette. You didn't pay your supplier, right? That amount, maybe stock was 50,000. That is a liability, right? It's squelette. So pretty much it's squelette. But right now, let us think of liabilities in the context of financing an asset, right? You're financing a house. A house costs 5 million, and when you only have 1 million, right? So you're gonna get the other 4 million from the bank. So that 4 million is your liability, right? So the same intuition sort of apply when it comes to investing, and it comes to companies, rather, right? And this specifically, when you look at the balance sheet, that's where uyibona kahle mawubuka i-balance sheet, because i-balance sheet sort of splits ama assets, ama liabilities, and the equity of a company, right? So I'll make an example. I have here this is AVI, right? AVI is a company. They own my choice assorted. Well, funny enough, we just came back from a holiday at December, so they made a killing, not December. So money lama choice assorted. It's AVI. It's this company, and this is in no way, shape, or form promoting AVI. By the way, it's just one of the companies in the JSE, right? You do your research, but let's get back to the topic. So I'm saying, AVI, for example, this is their balance sheet, right? How does AVI balance sheet look, or looks rather? So this was what from 2024. So $13 something that's way old, probably wouldn't materialize that much in njengamanje, right? So I think everyone remembers accounting about the balance sheet, with balance and everything. Your assets must be equal to your liabilities and equity, right? So that's sort of the thinking behind it, right? And the thinking behind it now, like a minute ago, I just said a house costs 5 million, right? And when you have 1 million, and you're gonna borrow 5 or 4 million from the bank, right? So the total amount of financing is 5 million, right? Doesn't it make sense as well that a company's assets should be equal to its liabilities plus equity? Because if all of a sudden your equities plus liabilities is equal to 5.5 million, you will have a problem now. Zobuzo ukuthi at like what's going on. I mean, I only wanted 5 million. Who's gonna pay for this other or additional 500,000? That's pretty much the intuition even behind the accounting, because accounting is the same thing for a person. I mean, yeah, for a person, just that it's done in the context of a company, right? So AVI, if we look at this, AVI has like non-current assets of 4.7 billion, 4.76 billion, right? Let's just drop AVI for now. Let's just call it the company. So this company has 4.7 billion, right? If you break it down, if you look at their non-current asset, because assets are broken down into two. There are two types of assets. There are non-current assets and current assets. So non-current assets, every asset that will stay within the company, or the company will use for more than 1 year. So think of like a chair, ohlala ngaso emsebenzini. Think of the laptop that you use when you work. Think of the building, right? As you can see here, this is property, plant, and equipment. That's pretty much the umbrella that they use. Property is the building, plants, it's vehicles like imoto, a factory as well. And then you have equipment, right? So that's usually the biggest. Usually for companies, that's usually the biggest item in terms of assets. It's usually the biggest item because, I mean, it's buildings. If a company owns a building, it costs a lot of money, right? Equipment to run the building or that will be running in the building costs a lot of money. So non-current assets are usually the biggest ticket or the biggest line item. And then below that, you have right-of-use assets, right? Right-of-use assets are things like copyright, right? It's not a physical asset, right? But it's the right to use something. So think of it like a license, right? Not really. Let's do that. I mean, we're on YouTube and we're learning right now. Let's Google search. But a right-of-use asset represents a lessee's contractual right to control and use an identified asset like property, equipment, or vehicles over a lease term recorded on the balance sheet. Yeah, it's a lease. It's a lease. I don't know what happens. I don't know. You know, when you live, sort of your brain almost freezes. You know, the thought of would you live. I don't know. Maybe it's because I'm still starting out and I'm still nervous about stuff. So I still miss my word every now and then. But yeah, and then you have intangible assets and goodwill. Still, things like intangible assets are things like patents. You know, if you think of think of a company like a pharmaceutical company, for example. A pharmaceutical company, they file a lot of patents, right? So all those patents will go there. Will go here, intangible assets. And then also here you see investments in joint ventures. There is investments in other companies. So they make investments. Could be small investments, not a lot, right? And then you have other long-term assets, and then you have deferred tax. I won't be technical into what are these things, right? That's not the point. And then if you look at current assets, right? Current assets, they will be used by the company within 12 months. Inventory, right? Stock. If stock cannot be here after 6 months. We have to sell it. We have to sell it within 2 weeks, 3 weeks, right? Biological assets, other financial assets, current tax asset, but basically trade receivables. So there's something called trade receivables as well. So trade receivables are basically what your customers owe you. So if you ngesikweletu, you sell something to someone on credit rather, and they haven't paid, you put them there. They are called trade and other receivables. And then you have cash and cash equivalents. So that is basically let's say bank. So it could be cash. Maybe it's not a bank. A company has like 5 bank accounts. And if you put them all together, they make like 352 million, right? And then current assets are 5.5 billion, right? And then non-current assets are 4.7 billion. But then if you look at the total, it's like 10.3, right? Now let's focus. And then always remember the 5 million example of saying this 10.3 billion is equivalent to the 5 million example I made earlier of a house, right? It's the same. And maybe now with these assets could be, if non-current assets in your house could be a chair, could be your plate. I mean, plates last longer than a year, as long as engafi at least. And everything. But all of these things, you can sort of put them in the context of a house. It grows in the house. You use it. within a month. So that's your current asset. But then if you look at the total, it's 10.3, right? And then now, if you look at equities, right? So we will, okay, look, before we get into equity, we talk about debt. So let's say now, how, think of it like this. How did this company finance these 10.3 billion assets? That's basically the point of it. Uguti, they have 10.3 billion assets, right? But how are they financed? Like, how much money did they put when they're buying a building? How much money did they put when they... But you won't see that in the granular scheme of things, because, I mean, this is one page. This simplifies a company that has a lot of buildings, right? But to sum it all up, right? If you say a building, a chair, a table, a printing machine, a pen, everything that's in the building. If you say we bought it for 10 rand, bought it cash, we bought this chair for 5,000, but we paid 2,000, we still owe 3,000. We bought this table for 10,000, but we paid 5,000, we still owe 5,000. So pretty much it's an aggregation. That's what you see when you see a financial statement like this, right? So then they say equity and liabilities. So equity and liability, so with balance sheet, they pretty much, they group them together, right? If you see here, total assets, 10.3, equity and liabilities. So they make a separate section for it. So then you have total equity, which is 5.7 billion, right? So that's pretty much, this is pretty much the 1 million equivalent of the 5 million example I made earlier, right? To say, this is what, if you are a shareholder, right? If you are a shareholder of this company, you have 5 billion to share amongst yourselves. Why do you have 5 billion to share amongst yourselves? Not 10 billion of assets. Because remember, the company has 10 billion of assets. So why isn't it 10 billion? That is because this 10 billion of assets is also financed with 3.3 billion of current assets and 1.1 billion of non-current assets, right? I mean, of non-current liabilities. 1.1 of non-current liabilities and 3.375 of current liabilities, right? That's the difference. Hey, Sion, how's it, my bro? You see, you need to check me on YouTube, man. I keep telling you this. So yeah, I'm saying, for assets and liabilities, what tends to happen is that they are differentiated into two. So assets are differentiated into non-current assets and current assets. Then liabilities as well are separated from non-current liabilities and current liabilities. So for example, think of it like this. A building that costs 20 million will be financed with a loan for 20 years, right? And then at the same time, or a company will borrow a loan for 20 years. They will not finance it for 5 years. And then at the same time, I made an example of a table that you bought it for 5K. That thing, you'll probably finance it for what? 3 months, right? So that 5,000 for a chair or for a table is a current liability. And then if you look at the 20 million for a building, which is for 20 years, right? It's more than 12 months. That's the only difference. Non-current and current, whether it's a liability or an asset, is current is within 12 months, non-current is after 12 months. If something is going to last more than 1 year, it's a non-current, whether it's an asset or liability. Anyways, so then this 5.784 billion is pretty much what's going to happen if, or pretty much is the residual, right, that will be shared by AMA investors of this company, right? Yeah, so that is equities, liabilities, and assets, right? So that's pretty much the idea of how you can read into them. But to be controversial about the house. In fact, there's this guy Robert Kiyosaki. I mean, a lot of people who read finance books or even interested into those stuff, like they know Robert Kiyosaki. He's famous for writing Rich Dad Poor Dad. He's famous for writing that book, and one of the things he says in that book is that your house is not an asset, right? And that ruffled a lot of feathers when he said it a long time ago, because Rich Dad Poor Dad is very old. I mean, it's a classic at this point. But he said your house is not an asset, right? And a lot of people were not happy about that. But there were a lot of nuances to it, right? It wasn't just a straightforward thing of saying, or just shitting on people and their houses and just calling their houses a liability, because everyone wants to think their house is an asset, right? I mean, most sevens they look taking indlu, right? Abantu basebenza they look taking indlu, taking imoto, and then once you're taking indlu, you know, you're settling down with your family and everything, right? And then you think of your house as an asset. You don't think of it. But let's just watch this video before.
Rich Dad Poor Dad, I came out in 1997. I said, your house is not an asset. And it drove people nuts. It just went crazy on me, because that's a common belief. But when you can't make your house payments, you find out is the biggest liability you got in many of the times.
It's turned out to be very much more correct than you even thought.
Right.
When you look at what's happened to home prices.
A big DT comes along. Donald Trump comes a long way. Donald Trump used to be a finance guru, man. Would you believe it? Donald Trump crawls so Ty Lopez could walk, man. You guys know Ty Lopez. I hope you guys know Ty Lopez. Anyways, let's watch this. Then we're gonna get back to our gurus. Like these were like the first gurus angempela
In 1997, when I released Rich Dad...
Man, I was muted. I was saying, Donald Trump used to be a finance guru. Donald Trump used to be a finance guru, man. Donald Trump walked so that Ty Lopez could think. He crawled so Ty Lopez could walk. That's what I was saying. Donald Trump used to be a finance guru. And these are like the OG finance gurus, if you really think about it, man. You know, those adverts on TV when on 11 episode. I don't know what people remember other things on 12. I mean, the only thing I remember on 12, 350, they were advertising music. They were advertising 313, 14. I still remember that till this day. And then these finance guru videos, I used to see them. I think they were American, most of them. But I don't know why they were playing American stuff. ETV, they were weird, man. But they were good. They brought us Champions League. ETV is goated for Champions League. But anyways, yeah, we were watching this. So I was saying Kiyosaki said, house is not an asset a while ago, right? And he ruffled a lot of feathers. Let's watch this.
In 1997, when I released Rich Dad Poor Dad, that book caused a bit of an upset because I said, your house is not an asset. So in today's world, if you want to be rich, you have to know the difference between assets versus liabilities. One of the reasons so many people are struggling financially today is simply because they're calling their liabilities assets, such as your house is not an asset, your car is not an asset, and things like that. So very simply, when I was a young boy, my rich dad taught me, he says, you have to understand a financial statement. So this...
What about this quality though, bro? It's not 2008, man.
This is an income statement. This is a balance sheet. Now, this is overly simplified. He says, what creates something to be an asset is very simply assets, cash flow money into your pocket. And a liability takes money from your pocket. So for most people, their houses are not assets or liabilities because every month it takes money to live in that house. Even those that say, well, I don't have any debt on my house, I paid it off. Look, you still have insurance, still have upkeep, you still have maintenance. So let me explain this. I'm not saying don't buy a house or don't buy this and all this. I said if this is a house and I rent the house out and every month it's putting money in my pocket more than my expenses, then that house is an asset. Now that very same house, if it goes unrented or somebody trashes it or whatever they do, that very same house can be a liability. So a house can be an asset or a liability depending upon the most important word in business. It's called cash flow. Once again, if cash flows into your pocket, it's an asset. If cash flows out, it's a liability. Think of it this way. If you stop working today, how much cash keeps flowing in? That's from assets. And if cash keeps flowing out, that's a liability. So I'm not saying don't buy a house. I'm just saying don't call a liability an asset. And that's what makes the Rich Dad Company different.
Yeah, pretty much. Pretty much. That's how he gives it up. Yeah, this guy, he's been giving it up like this straight up for years. Rich Dad Poor Dad was one of my, in fact, it was my second financial book I read. The first one was Wall Street. No. The Wolf. Yeah, The Wolf. Before I watched the movie. No, after I watched the movie. Like, after I watched the movie. So I watched the movie, then I downloaded the PDF. Then I downloaded the PDF. Man, I read that thing over holidays. I think it was December. After varsity and stuff, Sekai. I read it back and forth, and then there was the To Catch a Wolf. To Catch a Wolf. I think it was the second version, because I think there's two of them. And I'm not even a PDF person. I don't read books from my phone, to be honest, because it sort of kills my neck. I know, I don't like, always ngobile ngaso sonke isikhathi. Over time ngiyakhathala. I prefer a book, is better. I don't know, and it feels closer for some reason. A book feels closer and more realistic. I don't know. It's just, I guess, how my brain is wired, I guess. But yeah, is your house an asset? Kiyosaki said no. Unless it's producing cash for you, right? That's basically the basis of it. Other than that, there's not much. If your house produces cash, it's an asset. If it doesn't, it's a liability or cash flow, right? Because even if you paid it off, I mean, you heard him. Even if you paid it off, you still need to pay insurance, you pay taxes, you pay this, you pay that, you pay levies, right? So that's part of investing, and I guess it's more of a mentality. I think it's more of a mentality thing, investing rather. I mean, of course, you cannot monetize every house you live in, right? There will be a house or right? But the way you think about it, I guess, has to shift. Instead of just thinking about it, it's an asset. It is an asset per se, but make sure it makes you money. If it doesn't make money, it's not an asset per se, because he gets technical. And I think ukhuluma ngokuba technically, and when we look at the house as an asset, we look at it as a valuable commodity, such that if it's raining outside, this is my asset. I keep this, I own this, I get to say what goes on with this. So that's pretty much how we think of it when we say it's an asset. And he's speaking about it from an investing perspective to say, yes, it is, but what is really an asset? If you have two houses, that other building or that other house that produces an income for you is what technically is an asset, because technically an asset has to produce some sort of cash, right? Yeah, you see, now I'm messing up. I should move on from this topic. What do I want to talk about? I want to talk about Jerome Powell as well. Jerome Powell and Big DT, they are beefing. They are beefing. Donald Trump wants Jerome Powell to do something. Jerome Powell doesn't want to do it. Who's Jerome Powell? Jerome Powell is the Fed chair of the Reserve Bank, SA America, right? This guy. So this is Jerome. Jerome. Jerome has been in charge since I don't know, probably Biden years since Biden since when was when did Powell take over? Become Fed chair. Let's see. Yeah, 2018. That's Trump time, right? No, Biden time. I mean, no, it's Trump time. It's Trump. Yeah, what would Trump? Because Trump will put on 2020, right? Then we're going to Biden. Then yeah. So, but it was late in Trump's first term, right? So Jerome Powell is Fed chair. He's the equivalent of Khanyago here in South Africa. Like let's say Mr. Lere, let's say Khanyago. So Jerome is the equivalent of that guy. So whenever they talk about interest rates, when they go up or down, he's the chairman of the board, right? He presents what the Fed is going to do about the interest rate, right? So now the problem is that he's been beefing with DT about whether the interest rate should go up or down. Donald Trump wants the interest rates to go down, right? Why does he want to do that? Interest rates, when they are low, they stimulate the economy, right? People want to take more credit. Companies want to take more credit, right? Companies build more buildings. They build more factories. We just talked about assets, liabilities, and equities 2 minutes ago, right? So if my interest rates are low, it pretty much stimulates the economy. It's good for the economy, right? But then on the other hand, there's a problem or a balancing act that has to be done when it comes to our interest rates, whether we're keeping them high or low, right? You don't want too low interest rate such that there's too much money in the world because that causes inflation, right? And then at the same time, you don't want too much scarcity of email or our interest rates, they are so high such that people can't afford them and you're technically squeezing the consumer and even our businesses, right? So that balancing act is done by the Reserve Bank. Every country has a Reserve Bank, right? So in America is the Fed chair. Like the Fed chair is pretty much the Fed chair. I mean, is the Reserve Bank of the world because they pretty much work around the IMF. IMF is the International Monetary Fund, and they write loans for everyone in the world, right? Countries, in fact. So it's those sort of supernatural, or they're called supranational organizations, right? That are just overseeing countries. So the Fed, there's this thing that, or the Reserve Bank, every Reserve Bank, in fact, should operate independently, right? Independent of politicians. I'm a politician in Melengasholud. Just do politics and leave the banking to bankers, right? And especially to inflation. Because think about it as well. I'm a politicians, they have interests. They have their own interests and they have their own ulterior motives as well, right? For example, if we're going to election next year, wouldn't you be incentivized as a politician to start printing money and then you start making, or you make the nation feel like things are really going great when they're really not, right? Because that amount or that money you're printing is going to come back to bite you in a form of inflation. All of a sudden, it's in says 1,000 rand. Those are the repercussions when inflation gets out of control. We saw it in Zimbabwe, right? We're going to watch a video about that later. We saw it in Zimbabwe. In Zimbabwe, it happens when inflation gets out of control, right? So that balancing act has to be done by the Reserve Bank, independent of political influence. But now, Trump wants to intervene. I mean, he's intervening in oil businesses. He's intervening in every other country's businesses that interest him, at least, right? So he also now wants to dictate. In fact, he's been lobbying that he wants to put his own person there. So what they've done, they've hit this old man with a subpoena, man. What is a subpoena? Let's see this. These American terms. Subpoena. So a subpoena is a writ ordering a person to attend a court. It's a summon. I'm a summons. You basically summon to court with a subpoena. Thina la eSouth Africa sifocasa kuma-summons. Hey, nama-summons ebhank. I mean, nama-summons enkantolo. Oh my God, bruh. Oh, we're the best, man. We're the best. The way we just flip stuff up because it's too much. About subpoena, summons. That's just easy. Anyway, so they issued the Fed chair with summons, alleging criminal activity and alleging something. So let's just watch this video, though.
Good evening. On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment.
Okay, sorry.
Good evening. On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role.
Okay, so what? This guy. So what they did is they put charges of Batini. So apparently he wanted to renovate. They're renovating a building, the Reserve Bank building. So I guess he had to let me see. Powell testify. For renovations. Let's see, because it says DOJ. Okay. You see, I think it was a small. I think no one paid attention even to that testimony because there was a lot of reporting on it. Looks like there wasn't a lot of reporting on it, but basically what he's saying is, I guess this is the renovation. What to know about the DOJ's criminal so they're doing a renovation, I guess. So now Trump is saying with that, yeah, so Federal Reserve Chair under criminal investigation over headquarter renovations. It's like, bruh. So the U.S. Attorney's Office in Washington, D.C. has launched a criminal investigation into Federal Reserve Chair Jerome Powell over the $2.5 billion renovation of the Fed's headquarters. God damn. Okay. Makes sense. Yo, that's a lot of money, bruh. 2 billion. Okay. You know what? So manje kuthiwani uJerome uncinza u2 million yini lintani. Lo babuluke bungeke lungile mfethu. Like yawo yahlupha mfethu uTrump. Yazi uTrump yahlupha. So let's just go back a bit.
Democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's respect for the rule of law and renovate historic Federal Reserve office buildings. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people. Thank you. Confirmed me to do.
Yeah, that's basically that. That's basically that. So Jerome akafuni ukuzwa, basically. That's what he's guilty for. He doesn't want to be told. Jerome, drop the rate. Cut the rates by 50 basis points, Jerome. Jerome, you're going to be out of a job, Jerome. Cut the rates. Because there's even, by this time, there's even a guy who's even almost lobbying at this point. Like, he's putting himself out there, putting his opinions about what he thinks about the federal rates and stuff like that. You can already see his campaign. Well, if it was in political terms, it will be campaigning. And it just happens now, he's a Republican. So he's almost a Trump. He's a Trump guy, not even almost. He's a Trump guy. So Jerome's job is really at a threat. But isn't it crazy, though? Isn't it crazy? The narrative painting, it's sort of an emo in America, like, right? They just paint a narrative. Could be true, right? But whenever it is true, you always have to ask about the interest of bringing it up now, because you telling me if he's corrupt, is this the first time he's shown corruption? Because this is at the highest level. Like, this is quelling at the highest level. If we're saying Uzontshontshimali, it's like 2.5 billion. You renovate building of the federal the federal building money. You chow that. That's like you quelling at the highest level, bruh. Like, you defrauding at the highest level at this point. So you're a professional at this point. You must have had practice. So I'm saying, why didn't they bring it up back then, right? So they bring it up now because it's interesting or it's just convenient, right? But then the narrative goes out there, Yoni Gamala who corrupt and he's gonna have to fight very hard to prove it, like, right, as he's doing Jengaman. But the narrative is out. Like, he put me in number along Jerome right now. Almost the same way what put me number along in South Africa a couple of months ago, right? There's this, all of that nonsense they were saying. None of it existed. None of it exists. Black and white people know it doesn't exist in South Africa, right? But they will talk about it and they will say it and speak of it like it's the truth. But we will see. Maybe Jerome is corrupt. Maybe he did chow the money, God have been protected all this time. And maybe just this time they're saying he's had enough. So we will see. But Trump is coming for everyone. It's not Venezuela only. It's not South Africa only. Even bankers, central bankers in his own country, they are not safe. Let's
Federal
see this.
Reserve Chair Jerome Powell confirms he's now under criminal investigation by the Justice Department. He said officials are looking into testimony he gave to Congress in June about the Federal Reserve's renovation of its D.C. headquarters. But Powell claimed the probe is actually tied to, quote, threats and ongoing pressure by the Trump administration.
The threat of criminal charges is a consequence of the Federal Reserve setting interest rates.
Ongoing renovations, as you may recall, subpoenas related to be violating the law. Now, Powell disputes all that and described this new probe as unprecedented action, which he says should be seen in the broader context of the administration's threats and ongoing pressure related to interest rates and lowering interest rates. A DOJ spokesperson in a statement did not specifically reference this case, but said that the Attorney General has instructed her U.S. attorneys to prioritize investigating any abuse of taxpayer dollars. But lawmakers across both sides of the aisle are sounding the alarm. Republican Tom Tillis said this in a statement in part: if there were any remaining doubt whether Republican Tom Tillis said this in a statement in part: if there were any remaining doubt whether advisors within the Trump administration are actively pushing to end the independence of the Federal Reserve, there should be none. Other lawmakers warn that undermining that independence could destabilize markets. Now, President Trump told NBC News in a phone call Sunday night that he didn't know about this probe. As you may recall, it was President Trump who appointed Powell as Fed chair during his first term. But since then, he's repeatedly criticized him and has floated even firing him as recently as last month, Errol.
All right.
Yeah. He appointed him. When 2018. He's the one who made him the chair. So I don't know what changed. But I think more than anything, what changed between the first term Trump and second term Trump is the attitude. I think second term Trump gives zero fucks, bruh. I don't want to lie to you. I think second term Trump really doesn't care. I mean, he's 80. He's 80 something, bruh. And old people tend to don't care, but not even like they don't care, bruh. Like they decide like what matters to them. They've brought life to very simple things, right? They know what matters. They know what doesn't matter. And they go ahead and do what matters. And how you feel about it, good luck, right? And I think that's pretty much the attitude he's taken. Because even in the first term, he really tried. Like, you could tell Uguti, he was trying a lot to win over Abantu. Like, win over Ama countries as far as being diplomatic and stuff, right? But this time, none of that. Like, the diplomacy is out the window as far as Trump is concerned. It's almost like, you know what, I'm going to come here and do what I want to do. How y'all feel about it is for the benefit of America. I mean, I guess everyone who's in support of him, that's what he's saying, MAGA. Because, like, think of it like first term, he was saying he's going to make Mexico build the wall, bruh. Why should Mexico work border? But he didn't do it, But I want to think this second term Trump, he would do it. Like, if he had that rhetoric coming into the second term, I'm 100% sure by now. Or if it was up there, my priorities like, he would have started with it by now because he really doesn't care this time. Like, there's a World Cup next year. You would think ukuthi someone who's hosting a World Cup Ebola would behave in a certain way diplomatically, try not to alienate a lot of people. But you have ICE shooting Americans in the streets. Like, you have American police shooting Americans in the streets. Females at that. Not even, females at that. So it's a different country. It's almost like 2013, 2014, 15, Obama America. It's like America is getting back to that. But anyways, let's watch this one more time.
Overnight, with word that the Department of Justice is has launched a criminal investigation into Federal Reserve Chair Jerome Powell and the Federal Reserve. They say,
just see it right here, net approval rating per Democrats.
Talks about Fed independence, right? How important do the American people think that is?
Very, very.
And this is the important part, right? This is the important part about independence, because I mean it's a political question, as much as it's an economic question, right? I guess this is where politics and business and finance sort of interact, because as much as it's a finance institution, but it's a political institution, right? Because a decision they make have repercussions. They have repercussions that trickle down all the way to the real economy, not just it affects some investors, and it only affects you if you have a portfolio of invest. No, it affects your price of bread. It affects the price of, or your taxi fare, kokai. And it really starts in America, trickling down all the way to even like South Africa, because whatever America does, you can pretty much catch up and see what South Africa is doing, case in point, right? We pretty much almost we almost mirror what America is doing, because I mean, they're up there with our trading partners, and as far as financing, they are the central hub for financing, global finance in the world, right? You have IMF and you have World Bank in there, so everything sort of revolves around them, right? But I wanted to talk about, I don't know if I can find a Malema video where he talks about nationalizing of banks without compensation. Like, it's a political question. It's a political question.
Thank you very much.
Right.
It is indeed not shocking that
Bring it home.
the ANC has sent the so-called communists to come and argue against one of the fundamental principles of communism. Under Joe Slovo interest in the ANC. That's what they are doing. And that all of you who come here to give us examples of the banks that were nationalized and collapsed, you use African states and indirectly trying to create an impression that it is black African governments which cannot run completely because of the banks. When we went into a recession, it was the banks, and those banks were not owned by the state. They were privately owned. So who said private ownership is inherently progressive and successful? There are many examples of private ownership which have failed in the banking sector. None of you gave example of those because they are white run, and therefore white people can never be wrong. The state is black run and therefore cannot be relied upon. Who collapsed African Bank? African Bank was not state run. It was privately run, yet it still collapsed. So it is incorrect to suggest that everything else that is black run is going to fail. We must say to the ANC that the so-called radical economic transformation is just a lip service. You don't mean anything. We agree entirely that to nationalize under you will be the most dangerous thing to do. But we bring these motions here to expose your inconsistency.
You see, You see, that's the thing with nationalization. Like you can nationalize a bank as Malema. Maybe you have the best intentions, right? Let's just assume let's assume the best. You have the best intentions, but you don't know the third person who'll be in charge after you. What would be their intentions, right? And more than black and white, right? More than black and white. I mean, they are white and they are advocating for centralizing the bank, right? So it's more of a thinking that leans towards markets, right? Like free markets. I spoke about this from one of my other videos of saying free markets believe in such, like, let the market be. It's almost like the law of the jungle, right? Like even with Starlink right now wanting to come to South Africa, right? Starlink wants to come in South Africa, but bafuna a card, my comrade, right? And then the guys who believe in free markets, they'll tell you this: don't interfere with it. Like all these structures, BEE structures or any other structures from government, especially imposed by the government, we don't need them, right? We believe in free markets. Let Starlink come, and whoever wants to compete, they will compete with Starlink. They have to compete purely based on the product offering or the price. Either they're going to charge a lower price. I mean, we have rain here in South Africa, right? Surely when Starlink comes, they will compete with rain. So people who believe in free markets, they'll tell you that. Let free markets be. Let people choose. And then as well, they also will tell you when it comes to intervention by the Reserve Bank, they would want to see minimal as possible, like as low intervention from the Reserve Bank as possible. Because, like I said, let the market flow. If a company, or like Umalem was talking about banks right here, if a bank goes bust, it's okay, right? That means that bank was weak. There's an entrepreneur somewhere who's got ideas, better ideas, and who knows how to manage risk better, who's going to develop or who's going to build a better bank that's going to last 100 more years, right? And then people who don't believe in free markets, almost like a Malema and stuff, right, which are called like socialist or communist, they will tell you that sorry, I was fixing it. There's a puzzle here on TikTok. Sorry for that. So they would tell you, we want government intervention. Like you hear him saying, we want government intervention. Like he's saying that you guys are saying you don't want to nationalize because you, the ANC, are corrupt and you are going to fuck this project up. So we don't want to nationalize with you guys in charge. We'd rather be in charge because we won't mess it up, right? That's what he's saying. But he's saying we, the government, or the government of the day, then we will be interfering in the economy in this instance of owning the Reserve Bank, right, or nationalizing the Reserve Bank and giving the Reserve Bank a mandate, right? So it's that sort of thinking, or those two school of thoughts, right, in economics. It's the clash. That's why I'm playing Malema. It's the clash of those two school of thoughts in economics. But let's
just say, to quote the movie Tootsie, this is one nutty hospital, this back and forth. My goodness gracious. They think it's incredibly important that the Fed acts independently of Donald Trump, and they think it's best for the economy. We're talking about more than 2/3 of adults, 68%, 91% of Democrats, 75% of independents, and even 41%, 2/5 of Trump's base thinks it's important that the Fed acts independently of Trump for the best of the economy. So when you get 41% of Republicans and 91% of
I think that right there kind of blows Trump out the water, because even like that 41% are Republicans, right? And those are basically Trump, which are like right people who believe in free markets and capitalism and stuff like that, right? Those are sort of the recurring themes you'd find. So you see 41% of them, they're saying they want an independent Reserve Bank. And then this 91%, it's Democrats. Democrats, as much as they are Americans, because Americans, as much as they don't think like Malema purely in terms of black and white, because Malema's thinking is almost binary, right? He sees it for what he sees it, and he puts it like how he sees it, right? But Democrats are almost the closest thing you'd get to Malema in America, right? They believe in social grants. They believe in the government getting involved in some degree, right? As compared to Republicans. Republicans, they don't want none of that. Like, scratch those social security checks. I'm a grant like South Africa, 350. Scratch it. They don't want none of that shit. If you're weak, the market will put you aside. That's basically what they believe in. The market decides. Even when it comes to wages and salaries, as case, even when it comes to wages and salaries, they don't believe in what is this? Minimum wage. They don't believe in minimum wage because minimum wage is set by the government, right? They're saying if you're a worker and you're efficient, you will be hired. If you're not hired, I will be fired. I should be able to fire you. They don't believe in unions. Those are free market people. They don't like unions because some unions are totally can't. That's what they say. That's their thinking, right?
For the best of the economy. So when you get 41% of Republicans and 91% of Democrats agreeing on something with 75% of independents, you know it is a popular position. The bottom line is the American people vigorously disagree with the President of the United States on this. They want a Fed that acts independently of him because they think it's best for the economy.
So the Trump administration very clearly, to an extent, picking a fight
price changes like maybe every month, but right now it's like every week.
Yo, said so much. I've said so much. I was saying, you can't put the power to politicians, right? So I've been on mute this whole time on YouTube. Shit. So you can't put the power of the Reserve Bank on politicians, because politicians, they're their own interest, right? We saw it in Zimbabwe. I mean, I have a Zimbabwe video up right now. They have their own interest as far as the people are concerned. So then I was looking at the Chinese Reserve Bank, if it is centrally controlled, and it's not centrally, I mean, it's not independent rather, right? So it decides, but then while it has legal mandates for independent function, major monetary decisions require approval from higher government bodies, reflecting China's centralized political system where ultimate power rests with the party state. So they're not really a malema at China, like fully fledged left, such that they believe in full government or full government intervention. But as well, they don't believe in full private sector taking control, like you would see in America. Like private sector runs everything in America, right? So in China, they are like a balance of both. They're private, but if you get out of control, like you can't be Elon Musk in China. Jack Ma almost got out of control. They got him back. They recalled him and put him in order. He disappeared. Nowhere to be seen. I can't remember anyone saw like Jack Ma, or can't remember anyone saying they saw Jack Ma, even online. He just disappeared. So that's China. They're a balance of both, right? But politicians have their own ulterior motives. We saw it as Zimbabwe.
Last week I bought some mouthwash for about $52. Yesterday I went back. It's now $125. So generally prices are going up. We can't afford anything. Even the salaries are like close to nothing.
They must put the prices down. Okay. They must put the prices down because it's just too much. We can't afford. Especially we others, we don't go to work. The massive increase across the whole economy. So the economy, as I've said, we are in a recession where now people will not be able to afford. The demand for goods is just going to go down. And what is the end result of that? The end result of that, companies are going to close. People are going to become more poorer than where we were before.
So yeah, this is a video. Last one. Let's just watch this last video. Then we're gonna move to another topic. So it talks about how printing money actually creates inflation, right? Because it's an abstract concept, but it in reality it works, and we saw it in Zimbabwe, right? With this video I just played now. So it was not nice there. It was not nice. Taking 1 trillion is bad. Hey.
In March 2020, the COVID-19 pandemic rocked economies worldwide. Millions of people lost their jobs, and many businesses struggled to survive or shut down completely. Governments responded with some of the largest economic relief packages in history. The United States alone spent $2.2 trillion on a first round of relief. So where did all this money come from? Most countries have a central bank that manages the money supply and is independent from the government to prevent political interference. The government can implement many types of economic policy, like decreasing people's taxes and creating jobs through public infrastructure projects, but it actually can't just increase the money supply. The central bank determines how much money is in circulation at a time. So why can't central banks authorize the printing of unlimited money to help an economy in crisis? They could, but that's a short-term solution that doesn't necessarily boost economic growth in the long term and can actually hurt the economy. Why? With more money in circulation, manufacturers of goods like food, clothing, and cars could respond to demand simply by raising prices, rather than manufacturing more of these goods and creating new jobs in the process. This would mean you could no longer buy as much with the same amount of money, a situation known as inflation. A little bit of inflation, about 2% a year, is considered a sign of economic health, but more can quickly derail an economy. In recent decades, central banks have tried an approach called quantitative easing to infuse the economy with cash while maintaining a low risk of severe inflation. In this approach, a central bank increases cash flow by purchasing another entity's bonds. Anyone can buy bonds from corporations or governments. When you buy a bond, you're essentially loaning money to the company or government with the promise that they'll pay it back later with interest. This is why buying bonds is sometimes referred to as buying debt. When an individual buys a bond, they're using money that's already in circulation. But when the central bank buys a bond, it essentially creates cash, supplying money that didn't exist before in exchange for bonds. Both during the 2008-2009 financial crisis and again in 2020, the United States Central Bank, the Federal Reserve, bought bonds from the US government called Treasury bonds. Historically, many people have purchased these bonds as a safe form of investment, knowing the US government will pay them back with interest. In early 2020, the Federal Reserve pledged to buy unlimited Treasury bonds, loaning the US government an unprecedented amount of money, cash that the government used to fund relief efforts like stimulus checks and unemployment benefits. This isn't equivalent to simply printing money, though it may sound similar. Because of the way bonds are priced, by buying so many, the Federal Reserve effectively lowered the return on them, which incentivizes other investors to lend to riskier entities, like small and mid-sized companies, in order to get a decent return. Encouraging lending this way should help companies of all sizes borrow money to funnel into projects and hires, boosting the economy over time, in addition to helping the government supply people with urgently needed cash in the short term. The Federal Reserve's pledge to buy unlimited government debt has raised some questions and eyebrows. In theory, this means the government could issue more bonds, which the central bank would purchase. The government could then use the money from the new bonds to pay off the old bonds, effectively meaning the government never pays back its debt to the central bank. Citing this and other theoretical scenarios, some economists have raised concerns that a central bank buying government debt is a subversion of a system designed to protect the economy. Others have insisted these measures are necessary and have so far helped stabilize economies. Though quantitative easing has become a lot more common in recent years, it's still relatively new, and potential consequences are still unfolding.
That's pretty much it. They can't just print. Zimbabwe single sasibiza 1 billion at some point. Because imali loses value. It loses value, and think of it like this. There are five loaves of bread in this house, right? 5 loaves of bread in this room, in this flat, right? And then there's 50 rand in flotation. 5 loaves of bread is the food that is everywhere. Like, it's the only food in the world, right? And then there's 50 rand in the world that exists. It's the only money emhlabeni. 5 loaves are the only food in the world, right? So that almost equals what? One bread is 10 rand, 10 rand, 10 rand, 10 rand, 50 rand, right? Easy. So now think of it like this. As a person who's selling bread, say I sell 1 bread, now I have 4 bread. So now there's still $50 in flotation, but people who can buy bread, there's $40 in flotation, and I have four bread, or four loaves of bread. So now imagine some superficial power or some power that controls money, the printing of money. All of a sudden they print 500 rand more. Now there's 40 rand in flotation, remember? Or let's just say they print 400 rand. Let's to try and make it even. They print 400 rand more, and there's already 4 rand in flotation, and there's only 4 slices that I have as a person or the seller. What am I going to do to make sure I get the most out of these 4 slices or these 4 loaves of bread that I have? Because this guy just printed to 400 extra, right? What I'm going to do is I'm going to charge 410 rand, 110 rand for each loaf of bread. So now each loaf of bread is 110 rand instead of 10 rands, because there's just more money that was printed, right? It was printed, and at the same time, it did not match the production of the goods and services that it has to service or it has to buy, because this money that is printed somewhere has to buy goods somewhere, right? So now it usually happens when a company or a country prints a lot of money and then the output does not meet the volume or even the velocity, the speed that this amount of money is being printed with. So people are working, but they're not producing as much as, they're not producing enough goods. So I'm not making enough bread to pretty much satisfy all the money that's out there. And at this point, think about it. I'm not incentivized to, right? I'm not incentivized to produce more. I can only just raise the price. I'm going to make more. In fact, per unit, I'm going to make more. Because now my cost is like this much and my profit is almost all profit. 5,000%, I bet. Right? So that's the point about inflation, and that's the thinking behind it, such that printing money is not necessarily good if you think about it in isolation. I mean, it's bad if you think about it in isolation, but if it matches or it is matched with productivity, with a productive society, right, that constantly produces goods and services by Daisa and everything, so it kind of evens out. It gets swallowed into the economy, and then the economy grows. Cool. So that's pretty much the thinking behind it. Yeah, that's inflation. So we started with Jerome Powell, but the whole point was the importance of the independence of a reserve bank, right? Because there's just so much to balance. It's not just as simple as, no, we're going to use it to fight poverty, right? Yes, you use it to fight poverty, but then at the same time, there are other levers that move when you playing with interest rates or you're doing other things. Because there's other things that involve printing money. There's a lot of ways that a government or a reserve bank prints money or puts money into the system, right? But we'll go into that in a video. Maybe I should do another video. I'll do a video about it, right? 3 ways that the reserve bank print money. Okay, that's a video idea. Gonna put it somewhere. Gonna write it. Okay, anyways, I'm done now with Jerome. I wanna do like 1 or 2 more topics. Hi everyone on TikTok. Hope you're good. As you can see here, guys, I'm live on YouTube right now. So if you can join me on YouTube, you'll have a very great experience, because I'm sharing my screen, and I can't share my screen here on TikTok because suspend expeditiously. And I really want you guys to see some of these things that I'm working with here. But there's a link in my profile or in my bio. You can just go there. This stream that I'm doing right now, I will hang it up there. But also, all of these topics, I'm gonna chop them up and then re-upload them into like 20-minute videos, 30-minute videos, and everything. Yeah. So at YouTube, it's Investing Pod, and then here on TikTok, it's Suit and Assets, right? Still the same man. Just two accounts with different purposes. So yeah, that's that. Anyways, let us continue. What do I want to talk about? Yeah. I wanted to talk about Warren Buffett. By the way, if you guys enjoying the stream still, please like and subscribe to the videos. To the channel, and like the videos. It will help a lot to grow this channel. And so that I share more information, nami motivated, share more information, right? Proof of concept, which I'm not crazy. Because it's actually crazy when you're streaming alone and you're a small streamer, like you're starting out like I'm starting out. Because you really feel like you're talking to yourself, right? So it'll be great if some of you will join me here, either in the comment afterwards or when we stream. So the only way you can get these streams is if you subscribe and then you hit the notification button. But it doesn't matter. I hang these up anyways. I wanted to talk about Warren Buffett. Not even Warren Buffett, but it's a concept of timing the market, right? Timing the market versus time in the market, right? Because there are two things. There are two different things. So timing the market is about wanting to get the best possible price. So if you take a company when it's really cheap and you really think you can get that price, you want to time it. Like I'm getting is right, so that it just explodes and then you all profit, right? And then time in the market versus time in the market. So as compared to as compared to wanting to get a really good price when you're investing in a company, you really don't care about the price, right? A price becomes irrelevant, but what matters is the quality of the business, right? Is it a good business, right? Because if it's a good business, it doesn't matter if the price is 2 rand today or it will be 3 rand. Like 5 years, 10 years down the line, you'll be good, right? If it's a good business. This guy is known for owning a bunch of great businesses, Warren Buffett, right? Granted, he was very early. He started investing at a very good time, when America was just starting to be great, and the great boom, like the 60s, the 70s, the 80s, Warren Buffett was invested, especially the 80s. Warren Buffett was invested. So for those abangamazi, Warren Buffett, he's actually retired now, but he's an old man. He's a legend though. Goat of investing. So this guy, Warren, is like 95 years. Got to retire. He retired last year, or December, 2025, December. So his company is Berkshire Hathaway, right? Warren Buffett breaks down the habit that keeps him. Okay, anyways, we're not reading a Warren Buffett article right now. But this is his company, right? Berkshire Hathaway. So what? Berkshire Hathaway is just a holding company, right? He invests through this company. So he owns a bunch of businesses through a company, because you can own businesses personally in your personal capacity with your ID, right? Or you can own a CIPC company that invests in other businesses and invest in the stock market, in fact, right? But there are legalities that have to do with that. You have to speak to people that specialize or work with that, right? I'm not a financial advisor, Buffett. I'm just sharing information to guide you as to where do you go or start even, right? So this old man, right, that's number one, time in the market. So number two is how many stocks should you own, right? We're going to start with that. How many stocks should you own in your portfolio? Is it 3? Is it 4? Is it 5? What's the magic number? If he corner even, right? Yeah, so let's look at this.
I'm from Scottsdale, Arizona, and I am very interested in your policies on diversification and also how you concentrate your investments. And I've studied your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable equitable securities portfolio, and there was one year where you only had 3 in 1987. So I have 2 questions. Given the number of stocks that you have in the portfolio now, what does that imply about your view of the market in terms of, is it fairly valued, that kind of idea? And second of all, it seems that whenever you take a new investment, you never take less than about 5% and never more than about 10% of the total portfolio with that new position. And I wanted to see if I'm correct about that.
Yeah, well, on the second point, that really isn't correct. We have positions which you don't even see because we only listed the ones above 600 million in the last report, and obviously those are all smaller positions. Sometimes that's because they're smaller companies and we couldn't get that much money in. Sometimes it's because the prices moved up after we bought them. And sometimes it's because we may be selling the position down even. But so there's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about.
So still speaking of good businesses. So when he says good businesses are protected against competition, so there's something Warren Buffett calls a moat. So a moat is like an island. Think of a house in an island, right? Like back in the day, like these are castles. If you look at this, these are castles. Like I'm a Game of Thrones guy, so I like this. Right? So it's because there used to be a bunch of castles. I mean, Game of Thrones is centered God knows how many years ago. So, but it was back when people lived in castles and stuff, right? But you look at this castle. The reason why they built castles like this, like they would build water around the castle, or they would put whatever, like they could put army defenses here, they could put a bridge here to make sure it defends whoever is here, because whoever is officer to attack this palace, or this castle rather, they only have one entrance, right? And it's that entrance. So zombona umuntu, right? But then this is the moat, like this dam around the castle, right? It's sort of protected against invaders, you know. So that's how you should think of a business as well, like a good business like Coca-Cola, for example. Coca-Cola has patents up to here, you understand? I almost said something else, but they have patents up to here, you understand? They own a lot of stuff in the marketplace, such that if you wanted to create your own soft drink right now, you have a lot of work to do, my brother. You have a lot of work to do, my sister, because it will be so difficult for you to file these patents, the money that you would need, the skills you would need, right, to build that business, right? Who's gonna build that business for you? Are you a chemist? Because Coca-Cola was built by, I think, pharmacist. I mean, are you a pharmacist? Because Coke was built by a pharmacist. But that sort of thing, before we compete, the moat is pretty much what protects it. They're called barriers of entry. Like, I'm making a long story short, like a short story very long. But these are like barriers of entry. A moat is what is called a barriers of entry as well. Like all those things. It's like if you wanted to have your own ESCOM or power generating company, how much money would you need to start an ESCOM? It's a lot. Billions and billions and zillions. And then you need engineers, skilled engineers, experienced engineers who've worked at that highest level of engineering, because that's engineering at the highest level, right? You're quelling up there. People are not playing. Understand? So that's a barrier. The fact that you're not an engineer, probably you're an accountant, you're a teacher, you're a nurse, you know, it doesn't matter what you are, so long as you're not an engineer. Even if you are an engineer, but what do you know about amalahle and produce gas and stuff like that? So those are barriers of entry, right? So I'll make an example like YouTube. YouTube is a business with very low barriers of entry. Anyone can really just pick up a mic, attend a camera, and then I think most people have phones. People have phones. You use your phone. Like TikTok, you can be a TikToker. Everyone is a TikToker these days, right? Because the barriers of entry are so low. There's no moat around the business of being a content creator, right? You don't have to buy a machine that costs 100,000, right? A phone is like however it costs. But it's very relatively cheap, right? It's cheap, in fact. It's not billions. So that's the difference. That's the moat. So that's what he's talking about here when he says good businesses. So it really doesn't matter the number. That's what he's saying. It doesn't matter the number. What really matters is the quality of the business, right? Does it have the moat, barriers of entry? Does it produce does it produce cash consistently? Does it pay dividends consistently? You know, that sort of thing.
Against the vicissitudes of the economy over time and the competition. I mean, you know, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that
the GOAT, Charlie Manga's the GOAT. So Warren Buffett had a partner. This is Charlie Munger. He died
Charlie?
last year.
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
Charlie gives it up, bro. Charlie,
you want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and yeah, it's.
It has no utility, but I mean, it will tell you how to do average, but I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult, and it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues, but there is no value added.
I have great difficulty with it because I am something of a student of dementia.
So Charlie Munger was the sharper version of Warren Buffett. Like when I say sharper, like tongue-weighted is what I mean. Like his tongue, he says it how it is. Like he never held his tongue about anything. Charlie's legendary, man. Charlie's legendary. I think Shone last year. Yo. 2023 was 2 years ago, bruh. This feels like 2025. I swear to God. It feels like in the last year. Anyways. So, these guys are saying basically diversification is nonsense, right? It is nonsense. You don't have to own 20 businesses in your portfolio, right? You don't have to have 50 businesses in your portfolio, right? You can, if you're not sure about what you're doing. That's what Charlie is saying, or Ben Warren, right? But I think it changes and it varies based on your own goals as well. I mean, I did a video about. I talked about on my last stream. I talked about the 5 steps to follow before you start investing, and the first one was setting your goals, right? Are they mid-term, short-term, or long-term, right? Because like if you had Lomjito Bebu's, there was a part like he was saying Warren Buffett in 1987. Warren Buffett is famous in 1987. He had 3 stocks. He only had 3 stocks with portfolio yakhe in 1987. And what happened was that the market crashed in 1987. The 3 stocks. I could be wrong. Let me just double check that. Don't want to mislead people. Don't like misleading people. Anyways, let's just move on. But the point is, scratch the 3 stock thing. But the point is, at some point, but he said at some point you had 3 stocks. And then the thing about it is, if you know what you're doing, like Warren Buffett knew what he was doing, for example, he could tell when the market was overbought or when there was fish in the water and there was something fishy, like the valuations are too low high, our share prices are too high to non-maintainable levels, right? He could tell. So he knew how to sell. He knew how to dump stocks. He knew when to get in, when to get out. Like last year, I think he was dumping a lot of Apple. What is last year or 2024? He was dumping a lot of Apple stocks. Let's see, what is this? thumbs up, postdoc. Right. So I guess, yeah, they trimmed significantly their Apple stock holdings since late 2023, selling large chunks in quarterly filings. Though Apple remains a top holding with sales driven by high valuation, modest growth projection, and a desire to deploy cash, even as Buffett noted, he still views Apple as a strong long-term bet. Yeah, so that's basically it. Your goals will determine that, right? If you still want to take a risk on Apple, right? Go figure, right? And if you feel like you're not sure and you want to diversify and you want to own everything, because there's one thing Warren Buffett always stress is about investing within the circle of your competence, right? You're investing within what you know. So if we're accountant, you are trained in accountant, right? It makes no sense why your company that does electricity, an electrician company. It makes no sense for you to your plumbing company, right? If you're an accountant, most probably you practice your accounting. If you're a plumber, most probably you a plumbing company, right? If you're an engineer, you get the point. It's the same thing with investing. Why would you invest in engineering companies then if you don't understand engineering? You're investing it for the sake of investing because you know which is a great company because maybe you had so and so. Or maybe they have good financials, right? They really have good financials and they're doing well for the past 5 years, 10 years. But the problem with that is one-sided because more than anything, when you invest, you want to manage risk, right? So as much as they're a great company, they've been doing well according to the financial statements. But the problem with that is that it's outside of your competence. And the first question is, how will you know or how will you tell when they're not doing well, right? Or even when there are red flags because you don't know. But an accountant will tell you, good, once a company does XYZ, right, or a firm or a practice does XYZ, that's a red flag, right? Because it's within their cycle of competence. It's something abayazi. I mean, if you invest, of course, not everyone will engineer, but the point is invest in things you understand, right? Even if you're not a technical engineer per se, but invest in things you understand, which is how does the company make money? Those sort of things, they shouldn't be a great area. That part shouldn't be a great area, which how does a company make money? How does it source its raw materials? Who are its suppliers? Who are its partners? All that type of stuff, right? Stuff that you can do. Research on right? Then you can decide if you understand that. Then it's within your competence. Then there was another one about timing the market and I don't know if it was a tall line. Oh yeah, there you go. Should you wait for the market to crash?
If you find a wonderful business or a wonderful stock,
should you wait for the market to crash? Then
one that's going to remain great for 30 years. If it's going to be a great company for 3 years, 3 companies that you've terms. Well, I won't comment on the 3 companies that you've named, but in general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we We found See's Candy in 1972, where we find
Sears Candy. So there's a company called Sears Candy. That's one of 1972. That's when this guy bought. That's when they started investing in this company. I was born in I don't know. This is American stuff, bro.
and here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure that I'm not sure will be a great technique. I mean, it may be great if you inherit it. Paul Getty inherited the money at the bottom.
Yeah, he's basically saying don't wait. Don't wait for the crash. Like, for example, like in 2020, the market crashed, right? COVID-19, right? The market crashed. But then things like that, they are like black swan events. They are called black swan events. In the like something that you never, like an act of God per se. Like outbreaks of diseases, 9/11, depending on who you ask, 9/11, things like that. You can't prepare for them, right? And you can't prepare for them, but at the same time, you can't sit around, or you don't sit around and say, I'm gonna wait for this company to drop 70%, then I'm buying, because you don't know. Like this happened. Like, look at this. In hindsight, no, this is 22. Let's go back to 2020. 2020 actually, but yeah, this was the 2020 drop, right? This is what happened in 2020. If you look at this, this is like February, March, right? So this thing went from like 3.3 to 2.2. That's almost like 1,000. So within 2 months during COVID, this is the S&P 500. So this is an index that measures like the biggest 500 companies in America, right? So it's an index. But look at it now. You look at it now. Mawuguti, you said maybe, I don't know, you'll wait for COVID or something like COVID for you to invest. Uzophuthelwa because uzongena. And then there's another sell-off. I mean, you look at this sell-off young 2022. It's worse than 2020. So there's going to be a sell-off even when you have invested. Basically, my point is, even when you have invested, there's going to be a sell-off, and then the market is going to bounce back. Because let's say someone who just invested by the end of 2019, maybe by retire, they just bought something for living, like living annuity or whatever, right? Or they just started investing in 2019, and then the market crashes on them, right? Which is worse timing, right? They bought at the top at the time, like January 2020. Then the market crashed on them, almost half. It's like 33%. Yeah, it's like a third, right? So a third drops. But then you look at it now, that person is up, You check from like 3,200 back then, assuming you got at this top of 2019, which was the worst timing, right? You want to time the market, and you didn't get the timing right. But now, from then, like, this thing is touching 7,000 this week or next week. This week it's touching 7,000. S&P is going to touch 7,000. I think for the first time, not even I think, for the first time in history. And during 2020, it was what? 3,000 and something. So you can't time the market. You can't time the market. You're not a genius. Even geniuses have tried. Geniuses try every day. A lot of what am I doing? But I'm saying a lot of riches have been lost trying to time the market, basically. A lot of money has been lost trying to time the market because the only thing you have is time. So just sit, buy, don't sell, and sit through it. Eventually, the market rebounds. It's gonna rebound, and then you will be made whole again. So you can't time the market. You have time in the market. You invest within your competency, things that you understand, things that make sense to you, right? Yeah, that's that. That's that. I'm gonna end the stream here. It's 2 o'clock in the morning, bruh, and I got work in the morning. This was fun. This was fun. So everyone on TikTok, ngiyabonga. I see there's one person on TikTok. I'm gonna stop streaming.